All right, let's dive into this. This stack of info you've got here on rental property taxes. We've got IRS Publication 527 for 2024 returns, and looks like you're getting ready to become a landlord.
Smart move.
Yeah, but as you know, the tax side of things, it can get a little, well, tangled. So we're here to kind of help you sort it all out.
And what's fascinating to me is that the IRS actually gives you quite a bit of guidance on this.
Oh, that's good.
And they cover just about every possible scenario you might encounter.
As a rental property owner.
That's good to know because I have a feeling there are more than a few deductions I might be overlooking.
Yeah.
So let's start with the basics. Reporting that rental income. It seems like there are different ways of doing that depending on if you use the cash or accrual method.
Exactly. So think of it this way. The cash method is like tracking your spending with a checkbook. You record the income when you actually receive the money.
Okay.
But on the other hand, accrual method, it's more like using a credit card statement where you report the income when it's earned, even if you haven't received the payment yet. So if a tenant pays me rent in advance, like say for December, but they pay it in November, I would report that as income in November if I'm using the cash method.
That's right. With the cash method, it all comes down to when the money actually hits your bank account.
Makes sense. Now, let's talk about deductible expenses. What can landlords actually write off? I know mortgage interest and property taxes are kind of a given, but what else should we be aware of?
Whoa, there's a whole lot more than just those basics. So you can deduct things like your insurance premiums, repairs and maintenance, advertising costs, even legal and professional fees if you need to hire somebody to help with your rental property.
Wait, hold on. You're telling me I can deduct things like trips to the hardware store for plumbing fixes?
Absolutely. If you're driving around town to manage your property, those mileage costs are deductible. Even your travel expenses can be written off if you have to travel to collect rent or check on a property, especially if it's out of town.
Wow, that's a lot more than I expected. I'm starting to see why this deep dive is so important. Now, what about depreciation? I've heard that's kind of a major tax advantage for rental property owners.
Yeah, depreciation is like the IRS acknowledging that your property wears down over time. And they're giving you a way to recover some of those costs. So it allows you to deduct a portion of the property's cost each year over a set period of time.
So if I buy a rental property for, let's say, $300,000, I can't just deduct that whole amount all at once, right?
Right. Most residential rental properties are depreciated over 27.5 years using something called a straight line depreciation. What that means is you divide the property's cost minus the value of the land by 27.5. And that's your annual depreciation deduction.
So in that example, the $300,000 example, if the land was worth, let's say, $50,000, I'd be depreciating $250,000 over 27.5 years, which comes out to a little over $9,000 a year. That's a pretty significant deduction.
Exactly. And don't forget about appliances.
Okay.
So those are typically depreciated over a much shorter period, like 5 years. So if you've recently upgraded your rental's kitchen with new appliances, you're looking at some substantial deductions over the next 5 years.
Okay, so that makes sense. What if I'm not dealing with a standard single-family home? What if I own a condo or a co-op? Are there any kind of special tax considerations for those?
Absolutely. So condo owners can deduct those HOA fees that they pay, for maintaining the common elements of the property, like elevators, landscaping, security, all that. Co-op owners, on the other hand, they depreciate their stock in the corporation that owns the building rather than the apartment itself.
Interesting. So it's not just the physical property, but also how the ownership is structured.
Exactly.
Okay. Now, what if I decide to convert my current home into a rental property? How does that affect those depreciation calculations?
That's a common scenario. So in that case, your basis for depreciation would be the lesser of the fair market value of the property at the time of conversion or your adjusted basis in the property.
So if my home's market value has decreased since I bought it, I'd use the lower market value to calculate my depreciation deductions.
That's right. It ensures you're not depreciating more than the property's actually worth for tax purposes.
Good tip. Okay. What if I only want to rent out part of my property? Like a basement apartment or a spare bedroom? Do all the same rules apply?
In that case, you'd need to carefully divide your expenses between the rental portion of the property and the portion that you're using personally. So that includes things like utilities, insurance, repairs, even property taxes. You need to figure out what percentage of those expenses are attributable to the rental unit and deduct accordingly.
So if I rent out like half of my duplex, I'd only deduct 50% of those shared expenses on my tax return.
Exactly. It's all about accurately reflecting the business use of the property.
Okay.
And this is where good record keeping is crucial. You need to be able to justify those deductions to the IRS if they ever come knocking.
Okay, I'm starting to get the picture. But what about those situations where things go wrong? What if my rental property gets damaged in a fire or a storm or something?
That's where understanding casualty losses comes in. So if your rental property is damaged or destroyed by a sudden, unexpected event, like a fire, flood, earthquake, you might be able to deduct that loss on your tax return.
So it's not just income and expenses, it's also about protecting yourself from those unexpected financial hits.
Precisely. And we'll dive deeper into those casualty loss rules a little bit later. But first, let's talk about a situation that can be particularly tricky for landlords, which is what happens if you have a rental loss?
A rental loss, you mean like when my expenses exceed my rental income? I'm guessing that's not a good thing.
Not ideal, no, but it does happen, especially in the early years of owning a rental property, or if you encounter some unexpected repairs. The key thing to understand is that not all rental losses are immediately deductible. There are some special rules that come into play, like the at-risk rules and the passive activity limits.
All right, break those down for me. What are the at-risk rules all about?
Imagine the at-risk rule as a safety net. So it basically limits your deductible losses to the amount that you've personally invested in the property.
Okay.
This prevents you from claiming deductions for losses that exceed your actual financial exposure.
So if I put down a $25,000 down payment on a $100,000 rental property and end up with a $10,000 loss in that first year, I can only deduct $2,500 because that's my at-risk amount.
That's the gist of it.
Yeah.
But it can get a little more nuanced depending on how you finance the property and other factors. And then there are those passive activity limits.
Okay. What are those all about?
So in most cases, rental real estate activities are considered passive activities because you're not actively involved in the day-to-day operations of the business. And here's the catch. Passive activity losses can generally only be deducted against passive income, not your regular income from a job or other sources.
So if I have a rental loss but no other passive income to offset it, I can't use that loss to reduce my overall tax liability.
That's right. It's designed to prevent people from using rental losses to shelter their other income from taxes.
Makes sense.
But there is one pretty significant exception for people who are considered real estate professionals.
Real estate professionals, tell me more.
Yeah, so to qualify as a real estate professional, you have to meet two key criteria. More than half of your personal services in all trades or businesses must be performed in real property trades or businesses where you materially participate. And you must perform more than 750 hours of services in these real property trades or businesses.
So if real estate is truly my primary business, and I'm spending most of my working hours actively managing those rental properties, I might qualify for this exception.
Exactly. So if you meet those criteria, your rental real estate activities are no longer considered passive activities for tax purposes.
Oh.
Which means you might be able to deduct those rental losses against your other income, which could be a game changer.
Yeah, that is huge. That's a big advantage for those who are really making a living from real estate. But what about those of us who are just starting out or, managing a few properties on the side? Are there any breaks for us?
There are. So if you actively participate in a rental real estate activity, you may be able to deduct up to $25,000 of loss from that activity against your non-passive income, even if you don't qualify as a real estate professional.
$25,000, that's a decent amount, but I'm guessing there are some income limits and other qualifications involved.
You're right. So the full $25,000 allowance applies if your modified adjusted gross income, or MGI, is $100,000 or less. If your MGI is between $100,000 and $150,000, the allowance is gradually phased out. And once your MGI hits $150,000, the allowance disappears completely.
Ah, there's that MGI factor again. It seems to pop up everywhere in the tax code. But what exactly constitutes active participation? To qualify for this allowance, does just, like collecting rent, count?
Not quite. While collecting rent is definitely part of being a landlord, it's not enough to be considered active participation. For this particular tax benefit, you need to be more involved in the management decisions, like approving tenants, setting rental terms, making decisions about repairs and improvements.
So it's all about having a more hands-on role in managing that property.
Exactly. And documentation is key here. You want to be able to demonstrate to the IRS that you are actively involved in managing your rental property if you're claiming this deduction.
Okay, that makes sense. So we've covered a lot of ground here, from reporting rental income and understanding those key deductions to tackling depreciation and navigating all the complexities of rental losses. But we're not done yet, are we? There's still more to explore in this deep dive.
You're right. we still need to talk about those scenarios where you might be using your rental property for personal use, like family vacations or letting friends stay for a weekend.
Ah, yes. Those personal use situations, they can get a little tricky. I'm ready to dive into those details and see what other tax insights we can uncover.
Okay, so we've tackled some of the big picture stuff when it comes to rental property taxes. Now let's zoom in on something that I'm guessing applies to uh, a lot of landlords out there, which is using your rental property for personal use. I mean, if you've got a beach house or a cozy cabin, it's tempting to enjoy it yourself every now and then.
It's a common scenario,
Yeah.
and the IRS knows that, so that's why they have some very specific rules to make sure you're not claiming deductions for things that are actually personal expenses.
Right.
It's about finding that balance between personal enjoyment
Yeah.
and, legitimate business use.
Okay. So let's say I spend a couple of weeks each summer at my mountain cabin. Does that mean I can't deduct any of my expenses for the whole year?
Not necessarily. The IRS is looking at whether you're using the property as a home as opposed to just for personal purposes.
You use a dwelling unit as a home during the year. If you use it for personal purposes for more than 14 days, or more than 10% of the total days that it's rented to others
Hmm.
at a fair rental price, whichever is greater.
So there are two thresholds to consider. 14 days or 10% of the rental days. So let me see if I've got this straight. If I rent out my beach condo for 100 days out of the year, I can use it myself for up to 10 days without triggering those home rules.
That's right. But here's an interesting twist. If you rent it out for fewer than 15 days in a year, the IRS doesn't even consider it a rental property
Oh,
at all for tax purposes. So you still have to
right.
report the income,
Right.
but you can't deduct any of those rental expenses.
So if I rent out my place for like 2 weeks during a big event or a festival, I can't write off any of my mortgage interest, my property taxes, things like that.
Exactly. It's a way for the IRS to prevent people from, turning a short-term personal use situation into a tax shelter.
Got it. Makes sense. But let's go back to that scenario where I am renting out the property for more than 15 days, and I'm using it personally for more than that 14-day or 10% threshold. How do I actually figure out which expenses are deductible and which ones aren't?
That's where Worksheet 5.1 comes into play. It's basically a tool that the IRS provides to help you allocate those expenses between personal and rental use. And it comes down to proportions.
Proportions. Sounds like we're heading back to middle school math class.
Don't worry, it's not as complicated as it sounds. Essentially, you figure out the percentage of time that the property was used for rental purposes versus personal purposes. So let's say you used your rental property for 20 days out of the year and it was rented out for 80. That means 80% of the time it was used for business purposes, 20% for personal. And then you apply that 80% to your deductible expenses.
Okay, so if my total expenses for the year were like $10,000, I could deduct $8,000 on my tax return.
That's the general idea. It's all about separating those legitimate business expenses from your personal expenses. And this is where those detailed records really come in handy. You need to track those personal use days very, very carefully.
I can see where those calendars and spreadsheets come in handy. But what about depreciation? Does personal use affect those deductions too?
Absolutely. Depreciation is designed to, recover those costs over time, but you can only depreciate the portion that's used for rental purposes.
Okay.
So in that example where 80% of the time was business use, you'd depreciate 80% of the property's value.
So those personal use days impact both, like my current expenses and my long-term depreciation deductions. It's all kind of connected.
It is. And that's where Worksheet 5.1 really shines. Not only does it help you figure out that allocation of expenses, but it also guides you through some of the potential deduction limits and even lets you carry over certain expenses to future years if you can't deduct them all at once.
Carryover expenses. Tell me more about that.
Let's say your rental expenses for the year, including depreciation, exceed your rental income, resulting in a loss. So the worksheet will actually help you figure out how much of that loss you could deduct in the current year based on, your income, the type of expenses.
Oh, so there might be limitations on how much of a rental loss I can claim right away.
That's right. Some expenses, like those directly related to operating and maintaining the property, those might be fully deductible, even if you have a loss. But other expenses, like depreciation, might be limited. And Worksheet 5.1 kind of walks you through those nuances.
It sounds like Worksheet 5.1 is a pretty essential tool for anyone who's using their rental property for both personal and business use.
I'd say it's indispensable. It helps you navigate those gray areas where personal and business kind of intersect.
All right. Well, we've definitely covered a lot of ground when it comes to personal use and rental properties. We've tackled, those key thresholds for determining if your property is considered a home, how to actually allocate those expenses proportionally, and how personal use can impact your depreciation deductions. It's amazing how many factors come into play.
It's all about knowing the rules of the game and making sure you're playing by them.
Well said. But we're not done yet. There are a couple more intriguing scenarios that we need to explore. What happens, for example, if you decide to rent your property to a family member at a below market rate? Is that even allowed?
It is allowed, but it does raise some interesting tax questions.
Okay.
And speaking of unexpected situations, we also need to revisit those casualty losses
Yeah.
and how to handle them from a tax perspective.
All right, I'm ready to dive into those final topics and wrap up this deep dive into residential rental property taxes. All right, welcome back. We've covered a lot of ground here on rental property taxes, from deductions to depreciation and even those tricky personal use scenarios. But it seems like the IRS always throws us a couple more curveballs.
Oh, they do?
These what-if situations that, I'm guessing a lot of landlords run into.
Yeah.
So let's talk about family. What happens if you decide to rent your property to a family member, say your adult child or sibling, at a below market rate? Is that even allowed?
It is allowed, but as you might suspect, it does trigger some special tax considerations.
Yeah.
The IRS is always on the lookout for transactions that might be disguised as something else for tax purposes.
So if I'm renting my condo to my niece for like $500 a month, when similar units are going for, double that,
Right.
the IRS might get a little suspicious.
Exactly. They could view that as more of a gift than a genuine, arm's length rental agreement,
Right.
especially if the discounted rent is significantly benefiting a family member.
Okay, so let's say the IRS does see it as a gift. What are the tax implications?
Well, you still have to report that rental income that you receive, even though it's below market value. But your ability to deduct those rental expenses might be limited.
So I can't just write off all my mortgage interest, property taxes, and repairs. Like I was renting at fair market value.
Yeah. Right, because the IRS could argue that your deductions are excessive compared to the reduced rental income that you're receiving. It's like they're saying, look, you're giving your family member a break here, so you can't also expect to get all the same tax benefits as someone who's renting at market rates.
Right. That seems fair. So what's the takeaway for listeners who might be considering this kind of arrangement?
I think the key here is transparency and documentation. So if you can show that you had a legitimate business reason for setting that below market rent, you're in a much stronger position if the IRS ever, comes knocking.
Yeah.
It's always a good idea to consult with a tax professional in these types of situations, just to make sure you're doing everything by the book.
Yeah, solid advice. Now let's shift gears here to another scenario that unfortunately can happen to any landlord, no matter how careful you are. What happens when, disaster strikes?
Yep.
What if your rental property is damaged or destroyed by a fire or a flood or some other unexpected event?
Well, that's when understanding casualty losses comes in. We touched on this a little bit earlier, but it's worth going into a bit more detail.
Absolutely. These are the kinds of things that can keep a landlord up at night.
I agree. The good news is that if your rental property is damaged or destroyed by a sudden, unexpected event, you may be able to deduct the loss on your tax return. It's a way for the IRS to acknowledge that you've suffered a financial setback.
So it's not just a matter of saying, hey, my roof got damaged, I'm deducting $10,000. There's a process here.
There is. So you need to figure out your adjusted basis in the property, which is basically what you paid for it, minus any depreciation you've already claimed.
Okay.
This represents your actual investment in the property.
Makes sense. So you can't deduct more than what you've actually lost.
Exactly. And you'll also have to factor in any insurance reimbursements that you receive.
Right.
So the deductible loss is generally the difference between your adjusted basis and the insurance payout.
So if my adjusted basis in the property was like $50,000 and the insurance company gave me $40,000, my deductible loss would be $10,000.
Yeah, that's the basic calculation.
Yeah.
But it can get more complicated if the damage is really extensive or if you decide to rebuild or replace the property.
Sure.
There are some special rules and forms to deal with in those situations.
I bet. It sounds like dealing with casualty losses can be a real headache, both from, a practical standpoint and a tax perspective.
Yeah, it can definitely be a stressful and complex process. That's why it's so important to document everything. Take photos, videos of the damage, keep detailed records of all the repairs, and talk to your insurance agent and a tax professional to make sure you're handling things the right way.
Well, I think we've reached the end of our deep dive into residential rental property taxes. We've covered so much today, from the basics of, reporting that rental income and claiming deductions to those trickier situations like personal use, renting to family, and even those casualty losses. It's been a whirlwind tour of the tax code.
It has, but it's been a pleasure to guide you through it. And remember, knowledge is power, especially when it comes to taxes.
That's right.
By understanding the rules and planning strategically, you can maximize those deductions, minimize your tax liability, and, ultimately make your rental property a more profitable.
And enjoyable investment.
Well said. And a big thank you to all our listeners for joining us on this deep dive. We hope you found it informative and empowering. Remember, this is just a starting point. There's always more to learn. And we encourage you to keep exploring the resources that are out there, including those IRS publications that we mentioned, and to seek out guidance from those qualified tax professionals whenever you have questions. Until next time, happy renting.